In the previous video, we saw why your retirement timing matters. Retire at the wrong time and you may have a dwindling retirement portfolio. But don't worry, there are steps you can take to mitigate these impacts. Here are a couple of measures which you may already know. As one approaches retirement, pension fund managers often shift the portfolio allocation to reduce volatility. This often means including more bonds in the portfolio. In fact, if you look at Vanguard's retirement products, you'll see that as you approach retirement, the proportion of bonds in the portfolio increases. This, in theory, should reduce the large sways in value attributed to equity. Another measure is to use a dynamic withdrawal rate rather than a fixed rate. There are a few methods, but let me show you the difference between a fixed 4% rule and a dynamic 4% rule. Now, if you recall, a fixed 4% rule plus inflation takes 4% of the initial portfolio value and represents the amount that is withdrawn every year, irrespective of the performance of the portfolio. We'll refer to it as a static rate for the purpose of this video. And if you use this withdrawal method, this graph shows what would happen. Not too bad actually, no fail samples over 15 years. But now, let's say you withdraw 4% of the current portfolio value. Observe the difference between the two. As you can see, the dynamic approach is more robust, and in fact, using this method, you can't run out of money. The catch? Well, if the portfolio value drops significantly, 4% of its value may not be much. These are the actual withdrawals under the static 4% method. All the samples are the same. Why? Well, because no matter what your portfolio is doing, you always take out the same amount. Also, note that the withdrawals are increasing due to inflation adjustments. Now, if you compare the static withdrawals with the dynamic ones, you'll see two things. First, the withdrawals are different under each sample because each have their own performance and corresponding withdrawal values. Secondly, you'll see how the withdrawals also vary over time. So this unpredictability can be a big problem for retirees, which is why some people prefer the static X% method, or 4% as we use here. But here's what you can do. You can build up a reserve which you can dip in when the market conditions are not favorable. I like to call it a retirement emergency fund, and technically it is like an ordinary emergency fund, but a key differentiator here is that it's typically larger than the normal emergency fund, which typically represents 6 months of living expenses. With a retirement emergency fund, on the other hand, you're probably looking at a few years worth of living expenses to weather stock market conditions. The great thing if you have a retirement emergency fund is that it will offer some protection irrespective of whether you're using the static or dynamic rule. Again, let's illustrate this using historical data. I'm going to use a 6% static rule to exaggerate a portfolio failure and show you how a retirement emergency fund helps. On the left, you have portfolio samples without an emergency fund, and on the right, you have the same samples with a 10% emergency fund. The positive effect of the retirement emergency fund is different under each method. Under the static method, the emergency fund mitigates the detrimental withdrawals that hurt your portfolio in the long run. This is different to the dynamic method because you can't deplete a portfolio under the dynamic method, but instead it's your withdrawal amounts which will suffer. And that's where the emergency fund comes in. It smooths the withdrawal amount so that your fluctuations in income are not too detrimental to you. So I find it interesting how the emergency fund protects the portfolio under the static method, but protects you under the dynamic method. Now, you could argue that putting that much money aside is actually hurting the potential growth of your portfolio, and you'd be correct. However, this is one of those risk versus returns trade-offs. Therefore, what you might want is an emergency fund that is not excessively large so as to strongly negatively affect your future return, but at the same time offer some protection against worst case scenarios. So, how do we determine the right size for the retirement emergency fund? Well, that depends on your portfolio composition, retirement duration, and withdrawal rate, amongst other things. So it would be difficult to give a simple answer. But we can try to come up with some rule of thumb, because just like the 4% rule, we love a good rule of thumb. And that is precisely why we'll look into the next video, because in today's video I wanted to focus rather on the protective effects that an emergency fund can have on your portfolio. We've seen how even with the riskier static withdrawal method, you'd get some protection from using a retirement emergency fund. And that's it for me. If you found this useful, remember to like and subscribe. Thank you for watching and see you next time.